By now, it's a familiar story. Central banks around the world are raising interest rates to fight prices that continue to rise. In the United States, the Federal Reserve has raised its benchmark interest rate 4 times this year. And it's not done yet. Other countries, including Singapore, are taking their cue from Washington.
If you have a lot of debt, then your interest costs go up. But if on the other side, you're an investor, then suddenly you see these higher rates, then they are a lot more attractive at which you can deploy your money to get better returns. So it's not always a bad thing.
The most visible impact of higher rates is higher borrowing costs. In Singapore, bank home loan rates are now well above the 2.6% offered by the Public Housing Authority, HDB. If you had taken $1 million loan late last year, when 3-year fixed home rates were at about 1.15%, you would be paying about $3,300 a month for a 30-year loan. But now, DBS has raised its 3-year fixed rate to 2.75%, with OCBC and UOB also hiking rates. At that rate, your repayment would rise to above $4,000 a month, a nearly $800 increase.
So from an investment perspective, it seems to be that it still makes sense to hold on to that mortgage, don't pay it off, because although interest rates are rising, there is still potentially an opportunity for you to make more by investing. But that's from the investment perspective. We have also got to consider from the financial perspective, and specifically the financial health perspective. I think the question that you got to ask yourself is that if I hold on to that mortgage and as interest rate begins to go up, is it going to make my financial health no longer healthy? So if you're already in the unhealthy range, and if you have got cash in hand and sufficient cash in hand, you may want to then pay down. You may then want to partially pay off your mortgage. Of course, there are things to consider whether you are still in a lock-in period, what is the penalty for partial repayment.
It's uncharted territory after decades of low rates aimed at boosting growth and demand. Still, higher interest rates can benefit those who have saved up enough cash to deploy elsewhere.
Certain instruments are starting to look quite attractive, and you notice that the Singapore savings bonds are very, very oversubscribed. And the other kind of instruments that the government or the MAS issues also offer very, very high yields, 2% or even higher than that. So these are levels that we haven't seen in a long time.
So investors may deposit as little as $500 to a maximum of $200,000 anytime. And the Singapore savings bond can be redeemed anytime without penalty. And now with the interest rates rising, the SSB or Singapore savings bond yields have reached a record high.
Other options include fixed deposits or treasury bills.
If you are really looking for a place to park your money in the short term, then, high interest bank accounts is something that one can consider, right? A lot of these banks, especially our local banks, are offering those higher interest rate accounts if you meet the requirements. Other alternatives would be like your treasury bills. But I'll say that if you are investing for the long term, for example, for retirement, for funding of your children's education, for an objective that you want to achieve in the next 10, 15 years' time, the stock market, equities is still the best place to park your money, because equities has shown itself over history that it will always beat inflation. But in the short term, you have got to bear with the volatility.
Given the uncertainties ahead, and if you're thinking of equities, experts say traditional sectors with stronger cash flow are safer bets.
The financial sector may benefit as interest margins tend to be higher in a high-rate environment. Of course, if there's a general business slowdown, then this might have an offsetting impact on lending and financial institutions.
If you do have excess cash to deploy in stock investments, we would prefer to stick with companies that have a stronger cash flow, balance sheet, with lower leverage. And for example, this could also include some of the very popular Singapore REITs. And we will focus on REITs that have actually hedged their interest rate exposure to mitigate the impact of the higher interest rates. right? And these REITs tend to also generate and provide stable dividend cash flows for investors, and that could actually help to stabilize the overall portfolio returns.
In Singapore, you also have the option of topping up cash in the Central Provident Fund. The floor interest rate for the ordinary account is currently 2.5% and 4% for the special, Medisave and retirement accounts. Higher interest rates are expected to persist in the near to medium term. This will eventually dampen demand and reduce price pressures. However, it could be tricky to avoid a recession in the process.
I think that the key point here is that inflation was running too high for a bit too long, and there's a need to try and curb it. And if there's a price to pay, hopefully it is a mild recession, and then we can get on to a more healthy phase of expansion with lower inflation.